What's up, Marvin here. I saw a YouTube ad that spells out the reason why they prefer options over stocks because of 3 benefits. Number 1, it allows you to profit from the market in all directions, up, down or sideways. Number 2, it accelerates your profits because you can generate a higher percentage returns on a smaller capital size. Number 3, the risk is lower because you can let the options expire worthless. That's why they have created an options masterclass to teach you. They make options sound good, maybe too good. I would know what's the catch, right? Since I'm an ex-NTU physics graduate that went into finance. There are 3 big trade-offs that you should know before trading options, and whether you should invest your money or, more importantly, your time into learning options. 20-year-old Alex Keynes died thinking he owed $700,000 for stock market losses on an option trading platform in the US. Last month, his parents have sued Robinhood over his suicide. In a note to his parents before he died, he said, "I didn't know I would be taking on this much risk, and I only thought that I was risking the money that I actually owned. I also have no clue what I was doing now, in hindsight." It is true that options allow you to profit from the market in all directions, up, down or sideways. But the number 1 trade-off is that you could make a loss in all directions of the market as well. Furthermore, there is the possibility of limitless losses if you are potentially writing options. If not, is there something that is limited when buying options? In short, yes, your time is limited. So what if my time is limited? It means that you have to make a profit within a specific time frame, which accelerates your profit if your option is in the money. This opens up the possibility where your investment thesis could be right. In fact, you could be absolutely right, but you still made a loss. How come? Because your timing was wrong. Either you were too early and the options expired, or you couldn't hold long enough before you are forced to close your positions. There are rules to force close an option because of volatile market fluctuations, which was what happened to the Robinhood users during the GME saga. For beginners like Alex Keynes, who only had a small capital size, the risk, is it higher or lower in his case? It is difficult enough to get it right on the fundamental stock, but in options you have to be right twice. One on the fundamentals and one on the timing. If you could let your options expire, you could just keep opening up new options for the next quarter, and then the expiry would just roll forward again and again. You could practically roll forever. However, the trade-off is the cost of the options called premiums that you have to pay, which would add up over successive rolling. This reduces your profitability, even if you could start with a smaller capital. And if you were going to invest for the long term anyways, why pay for these premiums? Knowing the 3 big trade-offs, which are limitless losses, limited time, increased costs. All in all, if you got the 2 things right, the fundamentals and the timing, then the benefits could outweigh the costs. After all, if you have the time, you can learn how to time options. So why not sign up for Moomoo before 8th of March and get 1 free Apple stock, limited time only. Moomoo is a commission-free stock and options trading app. Their parent company, Futu Singapore, holds a CMS license or Capital Market Services licensed by MAS in Singapore. Use my referral code when you sign up, link in my bio. That's it, and I'll see you guys in the next video.